Good evening, everyone, or maybe good afternoon, depending on where you're at in the country. Thank you so much for joining our Virginia Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you today and get a chance to share with you a little bit more about homeownership and what it can look like for you. Tonight's class or today's class is going to run just about an hour, so should hopefully be wrapped up by the top of the hour. And it's really great to get a chance to get connected with you. I know in these, busy days and schedules, probably coming home from work right about now, probably the last thing you want to do is listen to a little bit about mortgage. But I think hopefully this will impart some information on you that will help you on your journey towards homeownership. Tonight's class is a very interactive session, so we encourage questions as we go through tonight's content. So we'll be rolling through different slides, and I would encourage you, if you have some questions about some of the content that I'm covering, please feel free to drop your question in the chat or Q&A, whichever is easier for you. We'll be monitoring both to make sure that we can answer any of those questions on air for you. Just a little bit about me, your presenter. Again, my name is Jason, and I work for an organization called American Pacific Mortgage. We're a nationwide direct lender, and we work in partnership with the Virginia alumni. So, it's an awesome opportunity for us to be able to connect with our alumni community and provide information on home ownership as well as some of our discounted services. And what we do is we get a chance to use our educational platform that you guys are joining us on tonight to really help you with those resources and support for home ownership. So we kind of specialize in first-time homebuyer programs, which you're going to learn a little bit about in tonight's class. And all of our work we do primarily with clients is across the country, and it's all done generally via video, just like we're doing in tonight's class. So here's a little bit about our talking points for tonight. So we're going to first of all start with a kind of a budgeting exercise, which is our rent versus buying analysis. We're then going to kind of talk a little bit about the housing market, where interest rates are at, a little bit of movement today that we can share with you in terms of what's going on in the market. Then we'll talk a little bit about credit, give you some tips and some resources around credit. We'll then talk about loan programs, student loans, and how that obligation may impact your eligibility for home ownership. We'll then move into documentation that's typically required for kind of building a plan for you with home ownership. We'll also talk about first-time homebuyer programs specific to the state of Virginia. I know many of you are in different parts of the country in tonight's class, but we'll talk about some other programs that are available all across the country. And then finally, we'll wrap up tonight's class looking at the kind of the workflow of buying a house. So after tonight's class, I say, hey, you know what? I really want to take a look at my options and set some goals and some objectives for homeownership. Where do I start from here? We're going to kind of take you down that path and show you what our 6 steps of home buying looks like for you. Again, tonight's class, we encourage you to ask questions, and everything that we're discussing tonight is going to be recorded. We're going to send out the video recording to you tomorrow, along with a copy of all of our presentation material. All right. So let's kind of talk a little bit about home ownership. And when we're thinking about home ownership, we have to make sure that it makes financial sense for us, right? There's a lot of great benefits that come along with owning a home. We have the opportunity of creating potentially generational wealth for our families in home ownership. As our home appreciates in value, the difference between what the market value is of my home versus what I owe on my mortgage, that difference is called home equity. And so as your home grows over time, there's opportunity to create a greater valued asset over time. Now, with a mortgage, there's also potential tax deductibility of interest that we sometimes overlook a little bit. So you'd want to obviously talk with a tax advisor, but you do have the potential tax deductibility of interest as well as part of a mortgage. So when we're thinking about home ownership and is this the right path for me, there's a lot of great benefits that come along with that. And that's why I would encourage you to think more about that, because, home ownership comparing to renting from a budget perspective is not necessarily an apples to apples comparison because of all those great attributes that are part of home ownership. So as we go into our next topic, which is budgeting, I want to kind of walk everyone through a budgeting exercise. And this is a calculator that we use through Freddie Mac. You're going to hear Freddie Mac a little bit later in tonight's discussion. But Freddie Mac basically has oversight of conventional loans along with Fannie Mae. So they support us in origination of about 70% of all mortgages across the United States. So let's kind of transition into our calculator and talk a little bit about or build, I should say, kind of a home buying kind of budget plan for us. So let me go ahead and share a different screen with you in our browser. And like I said, all this material that I'm reviewing with you this evening, we're going to send that back out to you via email tomorrow. So let's take a quick look at this. And I would encourage everyone in tonight's class, take some time on your own when you have a moment, run through this calculation yourself. But I'm going to kind of take you through a what if version as part of tonight's class. So here's the calculator, rent versus buying calculator. Let me kind of walk you through each section of the calculator. Pretty simple. Well, first of all, start with renting. And we're going to make the assumption that we're renting at $2,000 a month in rent. I do realize that's going to look a little bit different for everyone. So that's why I would encourage you, take some time to go ahead and do your own calculation when you have some free time. We also have renter's insurance that most of us would have as a current rental situation. We're going to have a projection that our rent will rise about 5% every year. And then from the home purchase perspective, we drop into that tab. We're going to assume a sales price of a home of $425,000. You're going to learn about loan programs a little bit later tonight, but the minimum down payment for a $425,000 home purchase is 3% of the purchase price. We have the expectation of property taxes. Usually how we calculate taxes as a baseline number is 1.25% of the purchase price. We have homeowners insurance that we're going to have to acquire as part of our home purchase. And then we want to also bake in maintenance costs. So the upkeep of our home, of course, if we decide to purchase maybe an older home, that's going to have more maintenance costs that'll be associated with that. But for today's budget, we're going to assume $1,000. We have loan information that we're going to add into the mix. So for most of our first-time buyers, we're going to elect a 30-year fixed mortgage. We have interest rates, which in this scenario, we put at 6.75. You'll learn more about interest rates in just a bit. And then origination charges are going to be the cost that a lender has in obtaining financing for you. Now, one of the great things beyond our classes that we provide to our Virginia alumni is our discount program. So our origination costs are discounted by $750 as part of our partnership with Virginia alumni. So that's a really cool benefit as well, too. And then discount points are where you as a buyer have an opportunity to lower the amount of interest rate that you pay by outlaying more cost. It's called discount points. And usually one discount point is the equivalent of 1% of my loan amount. So let's say I have a $400,000 loan amount, 1% would be $4,000. And then that $4,000 investment I make would equate to about a 0.25% reduction in interest rate. Now, in today's market right now, I'm not a huge fan of paying discount points because the break-even mark is about 4 to 5 years. So meaning for us to be able to catch up and break even on that $4,000 investment is basically going to take us about 4 to 5 years. And so that's a kind of a longer stretch than we would recommend, because for most of our clients buying in this 2024 market, they're probably going to be looking at refinancing in the next couple of years. So if your break even's 4 years, but you're going to refinance in 2, the math just doesn't necessarily add up. And then finally, other settlement services are going to be all inside of our closing costs to purchase a home. Closing costs will vary based upon what's negotiated with the seller, also depending on where you decide to buy across the country. And then other assumptions that we want to make is the appreciation rate of our home. So we're going to assume our home's going to appreciate by about 4% on an annualized basis. And for this forecast, we're going to add in 7 years that we're going to be in this home. We're going to have the cost of selling the home. So in our analysis, we're going to say, okay, at the end of 7 years, we're going to have to obviously pay realtor commissions and closing costs to sell our home. So we kind of just budget that at 10%. We have state and federal tax rate. And then finally, just comparing that to a high yield savings rate. So what our calculator does is first of all, let's take a look at a monthly perspective, right? So we know we're spending $2,000 a month in rent. The homeownership budget now takes us up to $3,600 a month. Clearly, that's a pretty sizable increase, right? However, I think when we look at homeownership, and again, not making it true, it's more of it's not really an apples to apples comparison, right? It's because we want to factor in all of these data points that we kind of just put in our calculator. So even though we're rising in budget, the opportunity in this example over 7 years is for us to create $48,000 in savings over the next 7 years by owning versus renting. And it kind of goes back to the benefits we talked about earlier. We look at appreciation of the home. We're also looking at tax savings that come along with home ownership versus renting. Now, for some of our clients that are looking at maybe refinancing their home 3 or 4 years from now, that's not factored in here. We're looking at kind of a current analysis based upon today's interest rates. Okay, so that's a great place to start when it comes to figuring out your budget and kind of sizing that up versus what it's going to look like from a rental perspective. Now, another thing that's going to influence our buying behaviors will be where the housing market's at, right? The higher priced home we have, if interest rates are still at the elevated levels that we're at today, that might change my buying behavior. But this is kind of a snapshot of just to show you what's going on with the housing market right now. Now, currently we're in the spring buying months, which traditionally spring and summer months are more of the kind of the seasonally busier months in the industry, because nicer weather. We have a lot of maybe families that are preparing to have their kids go to a certain school district. So all of those things could influence when we decide to start looking at purchasing a home. Quick question in the chat. And I just want to just make sure that we have everybody get the right information. And that was the question about just a recording of tonight's class. So yes, for those that put that, or for the guests that put their question in the chat, we will be recording tonight's class. We'll also be sending out all of the resources that I covered tonight via email to you tomorrow. All right, let's talk a little bit about the Virginia housing market. So median home prices you can see here on screen. So we got 458,000 is our median price. You can see a nice little uptick in prices, especially into 2024. What's driving a lot of that is just basically limited inventory and still some solid buyer demand. So when we think about kind of economics 101, right? Limited supply, we have high demand, that's going to push prices up. Why do we have limited inventory out there? Well, let's think about it. A lot of existing homeowners that decided to refinance 2.5 years ago, refinanced at 2.5%, 3% rates. Many of those existing homeowners don't want to trade in those rates to be move up buyers, right? And now have to incur 6.8 or 7% rates. So it's kind of put a little bit of a pause or maybe a slowdown in what inventory is available to buyers. Now that will change over time. We'll probably see that start to loosen up. In fact, we've already kind of seen about a 10% uptick in inventory across the market, but that's kind of where our challenge lies right now. As we look at interest rates, what we're going to talk about in a second, generally lower interest rates will fuel more buying activity. The thing that has to change is inventory levels for us to be able to have the support for buyers that are looking to purchase in today's market. Now, with what's going on in our state of Virginia versus the rest of the country is not really a lot different. When I was teaching a class for another partnership last night, very similar graph in a different part of the country. We're seeing a little bit of an uptick in prices, limited inventory, still pretty strong buyer demand, even in this interest rate environment. I think every buyer is looking for the perfect storm, right? Everybody wants the lowest interest rates, the lowest price homes. Probably not possible to really obtain that, because as we get to lower rate environments, buyer demand increases. And what has to change is the supply that's available to buyers. Now, let's look at interest rates right now. And I want to kind of do a 12-month look back on interest rates. So you can see our graph we have on screen. This is a look at the 30-year fixed mortgage over the last 12 months. Now, I mentioned to you earlier, 2 years ago, existing homeowners were taking advantage of the market. Some were buying at that time at 2.5%, 3% interest rate levels. Well, we're a far cry from where that is today, right? And why we're here at this current interest rate levels is really directly impacted by what's going on with inflation. So as we all kind of feel it daily, everything's a little bit more expensive. When we go to the grocery store, whatever we purchase is going to be a little bit more expensive. The cost of fuel, a little bit more expensive, right? So our day-to-day is more expensive. And so what the Federal Reserve is trying to combat inflation with is higher interest rates. So the goal of the Federal Reserve is to get inflation to 2%. Last reading we got was about 3.4%. So we're still a ways away from the goal for the Federal Reserve. But I think we do believe that interest rates will start to come down. It's just a question of when. And so, I think there's some speculation that at the September meeting that the Federal Reserve has, that they will cut interest rates, which obviously that's much needed in our housing industry. But you can kind of see what's going on with interest rates, and this kind of the peak of the mountain, so to speak. That's when interest rates hit 8%, which was a 20-year high in interest rates. Now we've kind of come off that high, thank goodness. And you can see we kind of had a nice little drop here, and we've kind of had this little bit of a roller coaster ride. And currently interest rates sit about 6.8 to 7%, give or take the day. Interest rates got a little bit worse today based upon some global PMI measurements, which kind of measure a little bit of the global inflation. So not only are we as a country in kind of a high inflationary environment, but they're also feeling it in Europe, for example. So in the UK, inflation readings came in a little bit higher than they expected. So those are all things that are kind of going on in the global market and right here at home that's influencing interest rates. Now, interest rates are not the same for all buyers. And I think it's important to understand that. So even though your neighbor, your colleague got X interest rate, it just depends on kind of the setup of their financing. And so here's some of the characteristics that go into that. So it starts with credit eligibility. So the higher my credit score is, the better my interest rate could potentially be. Depends on the type of product that I'm going to elect. Depends on how much I decide to put down for my down payment. We talked a little bit about discount points where you can pay additional costs out of pocket to bring down that interest rate. So if you remember in our budgeting exercise, 1% of my loan amount can equate to about a 0.25% reduction in rate. And then the term of my loan can also influence the type or the level of interest rate I have. Generally, the shorter my term is of my loan versus a longer term, like a 30-year, will bring about a lower interest rate. For most first-time buyers, they're going to elect a 30-year fixed mortgage because we're trying to get the biggest budget scenario, right? We're trying to get the best improvement in payment. So when we shrink down that term, also elevates the payment. So generally the 30-year fixed mark is kind of where we go for. Now, we meet with our clients one-on-one to design home buying plans. And we would encourage you to get connected with us after tonight's class because we'd love to be able to put together your own plan and kind of figure out what the right home buying option is for you. Now, one of the things that goes into designing that plan and guiding our clients is talking about credit, right? And credit's going to be one of the biggest influencers when it comes to product, my budget, and the overall kind of home financing solution that we put together for you. So I want to kind of spend some time talking a little bit about credit. And, most of our clients that connect with us have some type of monitoring tool that they're using for their credit. All that being said, though, most of those measurement tools are based upon the credit card model. So there's actually 3 different models when it comes to credit scoring. There's the credit card model, there's auto financing, and there's the mortgage model. So if you're applying for home financing, of course, we're going to use the mortgage model. So I thought it'd be helpful to kind of share with you what that FICO score calculation looks like. So we have kind of this graph on the screen here. And let's kind of walk you through each one of those kind of weightings, if you will. So 15% is going to be how long have I had credit. So the longer I've had account established, the more improved my credit score is going to be. So if I haven't had credit for more than 6 to 12 months, that score might be lower as opposed to another consumer that has had credit for 5 or 6 years. 20% is going to be how much new credit am I trying to open, but also do I have inquiries on my credit that are hard inquiries? Those would have about a 20% impact to my score. Now, in our process with our team, we always start with a soft credit check versus a hard inquiry. Here's the reason why. A soft inquiry does not impact your credit score at all. So we can view your credit as many times as we want, does not impact your score, whereas a hard inquiry does. Now, there is a rule in place for hard inquiries that you can have as many inquiries in a 30-day window of time for both mortgage financing and auto financing. So if you do work with a lender that automatically does a hard inquiry, you do have that 30-day window. But our kind of thought process with a soft inquiry is that many of our first-time buyers are building plans for a year out, maybe even 2 years out. So we don't want to create that impact in their credit score. Next component is credit utilization. How much do I owe? That's affecting our revolving accounts that we have. So simply put, if we had $10,000 in aggregate credit limits for credit cards, we had $5,000 in balances, that means I'm at a 50% utilization level. If you're at 80%, that means you have $8,000 in outstanding credit balances. The optimal level, I know we get different readings on this, but the optimal level for your credit card balances should be below 10% utilization. So in that scenario, be below $1,000 in total balances. Now, if we're maybe a little bit higher in utilization, so we're back up to like the 80% level, if we're just trying to whittle down our credit card balances, I would encourage you to get below 50% utilization. Let me give you a quick tip on how to manage utilization. And so maybe as a kind of a homework assignment from tonight's class, here's what I would encourage you to do. Take a look at one of your credit card statements. There's going to be two dates on that statement. One is a billing cycle or statement date. The second date is your due date, right? Most of us probably pay attention to the due date because that's when we have to make our bill paid on time. I would encourage you, take a look at the statement date. And if you can, try to pay down or pay off that balance before the end of the statement date. And here's the reason why I encourage that is because the statement date is the date at which the credit card issuer sends all your account information out to the three agencies, right? So Equifax, Experian, and TransUnion. And they report your history, your balance, your limit, all that stuff gets reported. But if you can pay that account down or off before the statement date, you'll get a much more improved level of utilization. All right, and finally, the last weighting is payment history. If you've had late payments, they'll be rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe on the late spectrum that we get, the bigger impact that we're going to have on our credit score. Anything that's has late payments or hard inquiries, things that could be negative items on our credit report, they're going to be the most impactful to your score in the most recent 12 to 24 months from the date of the event. Now, every loan program has a minimum credit score. So as we roll through our loan program section in just a little bit, just keep in mind every loan program that we take a look at for our buying plan will have a minimum credit score attached to it. Now, there's three scores each coming from the agencies, TransUnion, Experian, and Equifax. And so as a lender, we're going to take the middle credit score of all three scores. So let me give you an example of that. So if my best score is 760, my middle score is 740, my lowest score is 720. The 740 score is the score we're going to use from a qualifying perspective. Now, that's if I'm applying by myself. However, if my partner is going to join the financing, but let's say my partner's at 720 is their top score, 700 is their middle score, and 680 is their lowest score. Well, in that case, the lowest middle score between the two of us applying is going to be the 700 credit score. So that's important to know because that credit score is going to drive the loan program, which we just talked about, possibly the interest rate that we're going to select, as well as mortgage insurance that you're going to learn a little bit more about in tonight's class. Now, bigger events on your credit report, like a bankruptcy, short sale, maybe some collections that you've had in the past. Again, the most 12 to 24 months from the date of the event is going to be the most impactful. But items such as those larger events, larger negative events, I should say, will generally be on your credit report for at least 7 years. And then last thing I want to kind of point out here on this screen is account closure. And we're talking specifically about revolving accounts. And what that means is if you decide to close out a credit card, let's say it's an account that I've had for the last 10 years. When you close out that credit account, what you're doing is you're basically removing all of that history from the credit agency report, but also pulling the credit limit out of your aggregate totals for utilization. So when you do that, you can impact two key areas of your credit reporting. One is your credit utilization becomes maybe a little bit higher. Two is your length of credit could be impacted. So just be kind of careful before you start closing out accounts because it could negatively impact your credit score. Now, if you've had some past challenges on your credit report, this is a matrix to show you how long they'll retain on your credit report. Most late payments are going to be for the last 7 years. But again, the most recent 12 to 24 months is really where the score is going to be impacted. The late payment just might stay on your credit report for that 7-year period of time. All right, let's talk a little bit about student loans. And student loans, I do realize many of us have forgiveness of student loan debt, which is fantastic. But if we're back in school, those loans are probably in deferment. So if we're doing a master's program, for example, those are going to be in deferment. If you have a forbearance, then of course there's no payments due. However, on the lending side, regardless if we're in deferment or forbearance, we're going to have to still count a minimum payment when it comes to qualifying for our mortgage financing. Now, the general rule of thumb on a conventional loan is we're going to use 1% of the balance to qualify. So, for example, if I have $75,000 in student loan debt, the minimum payment I would have to qualify with is $750. If I'm doing an FHA loan, the factor is 0.5%. So that'd be half of that, right? So $375. If I'm in an income-based repayment program, which most of our clients are, then we take that minimum payment on the income base. So in the example we have on screen, if you were to have an income-based repayment that's say $250 per month, then that's the amount that we could use for qualifying purposes. Okay. But I think it's the important kind of takeaway here is whether I'm in forbearance or deferment, there's still a minimum payment that has to be counted into our budgeting when it comes to eligibility for the mortgage financing. Some of our clients are in public servant forgiveness programs where they're working in a public position. They have a 10-year forgiveness. Even though you're in a forgiveness program at the time of application for your mortgage, we still have to count that minimum payment for qualifying. And these are items we'll certainly review with you during your consultation if the student loans are something that needs to be kind of talked through a little bit more. We'll certainly do that with you during your consultation. All right, before I get into loan programs, I want to just make sure our audience knows if you do have any questions, you can just drop those in the chat or the Q&A function within Zoom. But any questions I can help answer from our audience? Okay. All right. Of course, just go ahead and drop those in the chat or Q&A if you do have any questions. Let's talk a little bit about loan programs. And so we're going to spotlight kind of 5 of the main programs that we generally will have conversations with clients around. And I want to give you kind of a high level look at each one of these programs. And the first one we're going to talk about is a conventional loan program. You heard me mention Freddie Mac earlier. So Freddie Mac, Fannie Mae are going to be for conventional loans. That's about 70% of all mortgages originated across the country. Minimum down payment for a first-time buyer with a conventional loan is 3% of my purchase price, up to a maximum loan amount of $766,550. So that's called the conforming loan limit. Now, if we have some of you that are joining us from California or New York or even in Virginia, some of our high cost of living markets, some of those markets will allow us to go up as high as 1.149,500 in total loan amount. That's called the high balance loan limit. But anytime we go beyond the loan amount of 766,550, that minimum down payment now will jump from 3% to 5%. On the conventional loan product, it has a minimum credit score of 620. And then as I mentioned earlier, interest rates change based upon credit score. So Fannie Mae and Freddie Mac have different adjustments of eligibility based upon credit score. The FHA loan product is a government insured loan, and FHA stands for the Federal Housing Administration. And the FHA loan program has varying loan levels based upon where you're going to purchase in the country. The loan amount that you're seeing on screen happens to be for the Virginia market. There's a minimum down payment of 3.5% on an FHA loan. FHA loans have a minimum credit score of 580. FHA, as compared to the conventional loan product, a lot more flexibility from a guidelines perspective. So if I've had a late payment, let's say that was just in December on maybe my credit card, it's going to be easier to move through the FHA product as opposed to a conventional loan product. Conventional is going to be a lot more strict from a credit score and kind of overall kind of history of payments, especially in the last 2 years on the credit file. FHA loans are not just for first-time buyers. So at times we have second and third-time buyers that are utilizing that product. So FHA can be a wonderful solution for some of our buyer scenarios. And then for our veterans that have eligibility for the VA home loan, the VA product's an amazing product that allows the veteran to purchase with no money down. It's a 0% down payment option, and it can exceed limits of $1 million in total loan amount. For some veterans, the VA funding fee, which is generally about 2.3% of the overall loan amount, can be waived if the veteran has exemption on the VA funding fee. And then the VA funding fee can vary based upon how frequently you've used your VA home loan benefits. But VA product is an amazing product, minimum credit score of a 620. For clients that are looking to purchase in kind of more rural areas, there's the USDA product, which stands for the United States Department of Agriculture. That is also a 0 down payment option. Works a little bit different than the VA home loan because, first of all, you don't have to be a veteran. But the 2 eligibility requirements are you have to purchase in what is deemed a rural area, as according to USDA, and there's mapping for that. 2 is there's income limits by household. So the USDA advantage is really the 0 down payment option, and it's not exclusively just for first-time buyers. And then finally, the jumbo home loan, those are going to be for buyers that need a little bit more financing above what we can offer with maybe a Fannie Mae or Freddie Mac product. Minimum credit score usually for a jumbo loan is going to be 680. And then with jumbo loans, it's a little different underwriting criteria because when we think about home ownership, we're going to have to save up for our down payment, for our closing costs, but they also generally require reserves. And reserves are additional assets that I have in my checking and savings account or maybe my 401k. That's the equivalent of 12 months of my monthly payment. And let's say I have a $7,000 mortgage payment, 12 months of reserves would mean that I have to have an additional $84,000 in assets. Jumbo loans aren't very typical for most of our first-time buyers, but it is a resource that's available to them. Now, in purchasing a home, when I decide to put less than 20% down to purchase my home, there's a thing called PMI, which stands for private mortgage insurance. And what we're going to do is we're going to talk a little bit about PMI now. There's two different forms of mortgage insurance. There's private mortgage insurance, which is part of a conventional loan product. And there's also government insured mortgage insurance, which is under FHA. So I want to kind of just break down both kind of paths for you so you can better understand that. So when we think about conventional mortgage insurance, there's different ways to pay PMI when it comes to a Fannie Mae or Freddie Mac loan. Typically, a buyer will pay that through their monthly mortgage insurance, so it'll be a monthly amount. But you have other alternatives too. You can split the MI up where you can pay some of it up front, some of it monthly. You can basically build it into your financing where you elevate your interest rate to completely buy out the mortgage insurance. You can also do kind of a single premium where you basically have an additional amount that's paid at closing that completely buys out your mortgage insurance for the duration of your loan. The most common option is going to be the monthly mortgage insurance option. And the reason why is because conventional mortgage insurance has a cancellation option that when I reach 2 years in my loan and I have 22% equity, I can apply to have my mortgage insurance canceled. Now, many of you that have already kind of started your home search on Redfin or Zillow have maybe taken advantage of some of their calculators that are available on those sites just to kind of figure out what a payment might look like on a particular house. When you look at those payment calculators, they're not necessarily going to be accurate, especially from a mortgage insurance perspective, because as a lender, there's different criteria that goes into mortgage insurance and the ultimate premium that you pay. It includes like what my credit score is, what my down payment is, and how much I finance. So a lot of times I'll be meeting with clients and they'll say, Jason, wow, that mortgage insurance is so much less than I saw on my search because it's not calibrated basically to what you're seeing here on screen. Again, I mentioned PMI for a conventional loan has a cancellation option, 2 years in that loan and 20 to 22% equity. So that's a big advantage of the conventional loan product. Now, when we look at the premium breakdown, here's kind of what it looks like. If I finance $450,000, let's say I'm putting 3% down and I have a credit score of 740, my mortgage insurance is probably going to be about $183 a month. Now, the more I can push my credit score up, the more I can put down, the cheaper my mortgage insurance is going to be. So that's conventional PMI, private mortgage insurance. FHA mortgage insurance is government insured, but it also comes with two forms of mortgage insurance. So there's one is upfront mortgage insurance, which is the equivalent of 1.75% of my loan amount. And there's also monthly mortgage insurance, which is 0.55% of my total mortgage. And then we just basically divide that by 12. That's how we come up with a premium. Now, with FHA mortgage insurance, there is no cancellation option. And that's an important kind of component of FHA mortgage insurance. So if our clients are looking to, 2 years down the road, get out of the FHA loan to get rid of mortgage insurance, we would recommend probably that we're going to refinance into a conventional loan, assuming they qualify. When you look at the FHA PMI calculation, we take that same loan amount of 450,000. The upfront mortgage insurance is going to be $7,875. So that gets actually added into the total amount financed. And then we have the monthly amount of that 0.55%, which is $206 per month. So clearly you can see the FHA mortgage insurance is a little bit more expensive because of the upfront and the monthly versus the conventional loan product. But I think it's important to understand that FHA loans have different qualifying criteria than conventional loans. Not only is there the minimum credit score requirement change or difference that we talked about earlier, a little bit more flexibility in the FHA guidelines versus conventional, especially if you've had larger events in your finances, like maybe a bankruptcy or a short sale. The seasoning period between both the FHA loan and the conventional loan looks a little bit different. All right, let's talk a little bit about documentation as it relates to income for your home buying plan. And so it looks a little bit different for both W-2 employees as well as self-employed clients. And so what I want to do is just walk you really quickly through documentation. And we're going to talk about a few different employment scenarios that come up quite often in working with our clients. So as we're preparing for our home buying plan and ultimately our consultation, as a W-2 employee, we'll generally need the last 2 years of W-2s, usually the last 30 to 60 days of pay stubs. And then throughout the process, we do a verification of employment, both usually on current and past employers. Now, if I'm self-employed, I'm going to need at least provide 2 years of tax returns, usually a profit and loss statement, and then we go through a different verification process for the self-employed individuals. Usually it's through a CPA letter or verifying like online, perhaps. Now, there are some minimum employment requirements in financing. So as a self-employed individual, I do have to have my business at least 2 years. So 2 years of active tax filings in order to be eligible to use self-employment income. Now, as a W-2 employee, it looks a little bit different. And this is kind of a misconception that we hear from a lot of clients that have worked with other lenders. So the rule in lending is I have to show 2 years of work and or educational history. So here's what I mean by that. Let's say I graduated from UVA in the fall and I just started a new job January 1, right? Well, if I was at UVA for 4 years and then now I just started my new job, because I have my educational background in my field of study, my field of study is connected to my new job, that would satisfy my 2 year requirement. So I don't necessarily have to be on the job 2 years. I could be, I could have studied in my current field, and that would satisfy the 2 year requirement. So we also have some cases where clients are switching jobs. That I work for one current employer that I've been with for, let's say, 2 years, but I'm getting ready to start a new job. Can I use the new source of income or the new employment? And the answer is yes. And sometimes we'll just verify that initially just through an offer letter. So that's completely a possible. Now, where that 2 year requirement gets a little bit trickier is that if I have dual sources of income. So sometimes we see this in fields like the healthcare industry. So I'll have clients that'll work at like two different facilities, maybe one for 30 hours a week, the other for 20 hours a week. In that case, we do have to show that that particular client has worked at both kind of facilities for 2 years simultaneously if we want to use both sources of income. That 2 year requirement also holds true if I have full-time job, plus I have maybe side employment. Let's say I drive for Uber on the weekends, right? If I want to use my Uber income that I earn, which generally will be part of my taxes, I have to show that I've been doing both jobs simultaneously for 2 years. Now, at times, clients have other sources of income, right? So maybe I have a partner that's not going to be part of the application, but also contributes to the household expenses. In order to count my partner's income, my partner would have to be an applicant as part of the loan process. Otherwise, I can't kind of factor that into the qualifying. And in some cases, we have clients that are also renting out a room, right? So let's say you're renting a place, but you're subletting a room to someone in your home. That income, unfortunately, in most programs cannot be used for future qualifying. Okay. So that's kind of a quick look at the qualifying income side of things. Now, we also do a kind of a review of income versus expenses, and that's called debt to income ratio. Really simply put, that's your pre-tax income versus your outgoing expenses. So those expenses would include things like personal loans, credit cards, lines of credit, as well as the new mortgage that you're going to have. And so generally speaking, as a lender, we don't want those expenses to exceed more than 43 to 45% of my pre-tax income. So here's kind of what that calculation might look like. So I'm looking at my principal and interest, property taxes, and my homeowner's insurance for my new mortgage. If I'm putting less than 20% down, I have what? Mortgage insurance. So that mortgage insurance gets factored in. If I'm buying a condo, maybe a townhouse, we have homeowners association expenses. So that's kind of my housing budget line item. And then I factor in my other expenses, maybe a car payment, maybe a credit card. So in this scenario that you can see on screen, if I have $3,000 in expenses and my gross earnings are $8,500 a month, then my debt to income ratio is about 35.29%, right? And for most first-time buyers, the kind of the comfort zone is anywhere between 33 to 36% generally. Qualifying wise, we can get as high as 43, 45, at times even as high as 50%, believe it or not. Now, keep in mind when we think about budgeting, I should say the debt to income ratio calculation, it's taking your pre-tax income. And we all know we don't net our gross earnings, right? So we have benefits, we have taxes that come out. And so that calculation is quite generous. So when we think about affordability for our clients, that's the most important thing because we want to create a plan that's affordable for you and sustainable over time. So when we meet with you for your consultation to design your own home buying plan, we want to talk more so about budget, right? So there's a difference between qualifying and what your affordable budget looks like. And so those are conversations that we'll have in supporting you in home ownership. Now, the last thing we want to talk a little bit about in kind of building our plan for us as part of tonight's class is around assets and savings. These are some of the documents that generally we will use to validate your assets for your home purchase. So checking and savings accounts, 401ks, 403bs, those can all be used. We would encourage you to talk to your tax or financial advisor before you use those assets. Gift funds can even be used in your home purchase. So if you have a family member that wants to contribute to your home purchase, they can certainly do that. There's a kind of a validation process for that, but that can certainly happen as well. When we think about home ownership for our first-time buyers, there's usually two challenges to getting closer to home ownership, especially in today's market. One could be on the credit side of things because maybe we're a little overextended, or maybe we've had some past challenges credit-wise. Two, and more likely, is that we just don't have enough savings to get to home ownership. Now, we're going to talk about assistance programs specific in the state of Virginia in just a few minutes, but I just want to kind of share with you guys a little bit about a concept around a savings plan that I think might be helpful for you. It's a really simple concept, but as I meet with clients and help kind of design home buying plans for them, we talk about what are you currently paying for rent and what do you think you could pay from a mortgage perspective. So if we have a scenario where, let's say I'm paying $2,000 a month in rent right now, and I think I can afford about $3,000 from a mortgage perspective, what I would share with that client to start doing to build up a savings reserve is to start paying yourself like you're making a $3,000 mortgage payment right now. So here's what I mean by that. Every month when I pay my rent, I pay my $2,000 to my landlord, right? But I have $1,000 that should be at some point going to my mortgage, that additional amount, right? Take that month, that additional $1,000, redirect that to your savings account, maybe a high yield savings account, and that money will grow over time. And so at the end of 6 months, I have $6,000 saved. At the end of a year, I have $12,000, not including interest that you'll earn in today's market. So that's a really simple concept to help you kind of build savings goals, or help you achieve savings goals in a shorter amount of time to help make homeownership that much closer of a goal for you. Now, as you hopefully do plans like that, there's also first-time buyer programs that are designed to support low to moderate income households all across the country. We're going to spotlight Virginia Housing's program because we're doing a UVA class, but I know many of you are joining us from other parts of the country. I would encourage you to get connected with us offline because there's various what we call housing finance agencies across the country, or HFAs, and they can help support us with resources for both down payment as well as closing costs. Now, within Virginia, there's a few different programs. There's the flex down payment options for both DPA, which DPA stands for Down Payment Assistance Grants. There's the Virginia Housing Plus Second Loan, which basically there's creating lower financing instruments for you in home ownership. The DPA grant allows you to borrow 2 to 2.5%, but it is a grant, so it's forgivable. So meaning the funds do not need to be paid. And there's also the Virginia Housing Plus Second Mortgage, which allows you to borrow up to 3 to 5% of the purchase price. And then you can allocate those to down payment or closing costs. This screen kind of shows you the income limits because these are designed to support low to moderate income households, but this kind of gives you a snapshot by county in Virginia what that eligibility might look like. Different housing agencies will have different income limits, and some are a little bit more lenient than others. For example, if you're in California, most of the HFAs will allow you to go up to 150% of your median income. So depending on where you're thinking about purchasing, there should be a first-time buyer program in your particular state that can help you, and we'd be more than happy to connect with you and provide you some guidance there. as we get towards the end of tonight's class, I want to walk you through what the process looks like for home ownership. So after tonight's class, you may say, wow, I want to kind of figure out more about what home buying might look like for me. So we're going to give you the steps to schedule a consultation with us in a bit, but I want you to understand kind of an overview of like what's the workflow look like of buying a house, because after a consultation, designing a plan for you, the output of that consultation is to be pre-approved for your home mortgage. What a pre-approval does is it kind of gives you a baseline of eligibility. So you'll know what your purchase price you're eligible for, what the market rate is that we're looking at today, estimated payment, estimated out-of-pocket expenses. That all comes with a pre-approval. But more importantly, that pre-approval is a certificate that you can use to start making offers on a home. The pre-approval is usually good for 60 days, but it can always be recertified at any time. We meet with clients that are looking to buy in 2 weeks from now, 2 years from now, maybe even 3 years from now. So there's no like time sensitive nature to the consultation or pre-approval process. But ultimately, we want to create a baseline for you for eligibility as part of your home buying plan. Step two is going to be the home search. And so after pre-approval, if we're ready to go, we want to start looking at homes, we would encourage you connect with a local realtor that should be an expert in that community that you're considering. We have a fantastic network of preferred realtors that we can connect you with too as well. Generally, in most markets, realtors are going to be paid for by the seller if negotiated, but a realtor should be an expert in their community, know the school districts, know the tax rates, understand kind of the buying climate. And so that realtor will help really be that expert to find that right home for you that fits kind of your goals and objectives of home ownership once we have that financing in place. Now, to fast forward a little bit, let's say I make an offer on a home. That offer gets accepted, right? Then we're going to move to step three. So that means entering escrow, and it means different things in different parts of the country. But entering escrow ultimately means that you have an agreement with the seller to purchase that home. That process from agreement to getting your keys generally is going to be 30 days, depending on where you're looking to purchase. Sometimes that can be as short as 14 days in your more competitive climates. Now, once your offer has been accepted, you're going to get a call from us and say, hey, congratulations, Jason. Super excited about you finding the right home that works for your family. We're then going to schedule you for a follow-up consultation. In that follow-up consultation, we're going to review the current market interest rates, talk about your out-of-pocket expenses, go through kind of the redesign of your financing as a follow-up from your earlier conversations with your consultation. Now, within a couple days after the acceptance of offer, you'll be required to make a deposit on the house. It's called an earnest money deposit. It's usually the equivalent of 1% to 2% of my purchase price that will count towards my total out-of-pocket. By that time, your realtor will have organized inspections of your house. We're going to send an appraiser to appraise the house because we want to make sure the home is worth what you're purchasing it for. So those are all kind of important kind of get started items, if you will, as part of the process. Here's what an earnest money deposit looks like. It's phrased as different things across the country, but as kind of a baseline terminology, earnest money is ultimately kind of the financial investment you make in a home once you have a ratified agreement with the seller. Now, in most parts of the country, there's a timeline called a contingency period, which is in the first 14 to 17 days of the contract. And that allows you to do your homework on the property to make sure this is a sound investment for you. That would include getting the house inspected, as I mentioned earlier, getting the house appraised, and then as a lender, we'll get the loan approval completed for you as well. Step four in the process is going to be the processing and the underwriting of the loan. So what does that mean? Well, that's the administrative work that we do behind the scenes. We verify your employment, verify your assets that you're using. Of course, we'll do another credit check. Also, by that time, we've locked in your interest rate on your home financing. For most programs, until you actually have a secured agreement with the seller, your interest rate is what we call is floating until the interest rate gets locked in. And that locked-in interest rate will carry you all the way through the end of the process. Step five is going to be the loan approval. And that's where an underwriter has reviewed all your documentation and kind of said, okay, yep, we're all set and ready to go. It also takes us about 3/4 of the way through the process and takes you right up to your contingency period. So if everything checks out with your inspections, your appraisal's good, you have your loan approval, then you're okay to remove your contingencies. And that gives signal to the seller that you're ready to move to the final stages in the process. Simultaneously, as a lender, we're going to be issuing to you a final closing disclosure. And it gives you a 3-day cooling off period on your financing to make sure you feel good about everything before you go to the very final milestone. And that's called the closing of the loan. That's kind of the in-person process of the financing, because everything up to that point is all done electronically via e-signature. At step 6, it's still an in-person process where you meet with an attorney or notary, depending on the state you're in, to sign documents in person. At that time, you also wire in your final funds that are needed in your home purchase. That money gets reconciled along with your loan financing funds by an escrow team or attorney's office. That money gets kind of settled. And once that's transpired, then documents get recorded with the local county recorder's office. They record a grant deed to transfer ownership to you, as well as a deed of trust, which is your agreement to repay the loan. And so after confirmations are all made on that recording, then you become the official owner of the home. That's one of the best days that I have, where I get a chance to call our new homeowners to say, hey, guess what? You guys did it. You've got to the finish line. You're now new homeowners of your home. And that's just one, like I said, one of the best parts of my day. It doesn't come without, a little bit of stress, a little bit of anxiety as you go through the process, because this is going to be a big purchase for us, right? It's going to be one of the largest investments we make in our upcoming financial futures. But we're here to help support you through the process and create a phenomenal client experience. If you're thinking about moving forward after tonight's class and designing your own home buying plan, we'd love to get connected with you for that. You may even have some questions after tonight's class. If you do have some questions, you can just get connected with us by scheduling an introductory call. If you're ready to start building your own home buying plan, we'd love to be able to meet with you for a consultation. What is a consultation? Well, that's a free service that we provide to you, and it's a one-on-one meeting with me to help design a plan. And it looks very similar to what you've heard in tonight's class. Understand a little bit more about where do you want to buy? What type of property are we looking at? Give you a sense of what interest rates look like and design a budget for you. Help maybe provide better guidance on credit. Look at what our savings plans needs to be, and kind of build that path towards home ownership for you. Again, it's a free service we provide to you. It's a 30-minute video consultation. And then if you decide you want to be pre-approved, it's that would be the output of that session. And reminder, that's just a soft credit check that we do with that consultation, so you don't have to worry about your score being impacted. So really great service that we provide, and just really helps create just an awareness and set some goals and objectives for home ownership. Now, we also have some great resources to offer you as well, including our mobile app. In fact, you can start the process all via mobile, even upload documents for the process. All can be done via mobile. It also has a great calculator feature available for Android and Apple. Really encourage you to check that out. Now, we talked a little bit about our partnership with the University of Virginia alumni. Couldn't be more happy and grateful to be able to partner with each of you in bringing this content to you. And we do have other partnerships across the country that we want to make you aware of. So if you do have friends, family, coworkers in other parts of the country that you think would benefit through some homebuyer education, we'd love for them to kind of check us out at mortgageeducate.com. Here's all my contact information. So if you do have questions about any of the content I've reviewed tonight, again, we're going to send out the recorded version tomorrow morning along with all of our presentation material. But if you have some questions, feel free to reach out to me. We'd love to be able to be a resource for you on this path towards homeownership. And we'd encourage you to follow us in some of our socials like Instagram. We try to put a lot of good content out there to help our first-time buyers in this process. Also encourage you to check out some of our reviews online. We take a lot of pride in the experience for our clients because we understand this is going to be a big investment for you and a big commitment. So we want you to see kind of what our clients are saying about us, especially a lot of our clients that have attended classes just like you have attended tonight. In fact, we've been doing these classes for over 8 years now. We get the pleasure of educating well over 3,000 future home buyers a year, and I'm glad that we got a chance to bring this content to you this evening. So with that being said, I want to be able to I know we're just before the top of the hour, but I want to open it up for any Q&A that we have from our audience. So if there's any questions you have, you can drop those in the chat or Q&A, and I'd love to be able to answer those on air for you. Any questions out there? I know for many parts of the country, I'm before dinner, right? So I know probably a lot of us are ready to start our evenings. But I do appreciate you spending some time with us. We did have a question that popped in the chat, which was, what was the credit score requirement for the high balance loan? So we didn't talk specifically about a credit score minimum for the high balance loan, but for the conventional product, it's usually 620. And when we get to the high balance loans, probably 660 to 680 was where I would probably say we land on the high balance loan. When we were at, that maybe say the 620 to 640 level, we really want to maybe start thinking more so about FHA product as a possible solution, because when we get to the lower credit score levels, FHA could make a little bit more sense financially for our home buyers. And the reason why I say that is because the FHA product is going to be priced a little bit differently than the conventional product, whereas the interest rate might be a lot more significant on the conventional loan, especially for some of our lower credit score clients. Great question. Thanks for that. Any other questions from our audience? Okay. I think we're all set. I do appreciate everyone joining tonight's class. Hopefully you found this information helpful for you. Again, if you have friends, family, coworkers that would really benefit from some of our educational classes, they can check us out at mortgageeducate.com. I look forward to hopefully getting connected with each of you to help you with your own home buying plan, and we'll talk to you soon. Have a good night.